Before we delve into what is a share and share capital, let us see why exactly do we need a company form of business. Because the other forms of organizations like sole proprietorship, partnership, etc. are limited by the capital which they can generate, as the number of people involved in it will be very less. For example, in case of a proprietorship, there will be just a single owner, and in case of a partnership, the maximum number of partners there can be is limited to 10 in case of banking business and 20 in case of non-banking businesses. It is also easy for the investors to invest if it is a company, especially if it's a listed company. Then they would have to simply subscribe to the shares of the company from the stock market. Also, talking about the liability, in case of a partnership or a proprietorship, the liability of the owners is unlimited. That means their liability is not restricted to the amount which they have invested in the business, but extends beyond that to their personal wealth as well. To avoid such risks, it is better to use company form of business. That's why businesses shifted to company form of business, where the liability is limited to the amount of capital invested in the business or the amount of capital supposed to be invested in the business. Also, a firm or a proprietorship concern will exist only until the existence of the partners or the proprietor. Whereas in case of a company, since it's got a separate legal existence, it will continue to exist irrespective of the life of the shareholders. Shareholders may come and go, but the company will be there until it is legally wound up. Customers will also usually trust more if they are dealing with corporations or a company, as they feel it is more permanent as compared to, say, a firm or a proprietorship. A company form also looks more professional than other forms which do not have to follow as many legal processes as a company would be required to do. One of the reasons why we have company form of business is that there will be no insufficiency in terms of capital. Because since it's a company, many people can contribute towards the capital of that company. The sum total of all that is known as share capital. So what's a share then? A unit of such share capital is known as a share. The company will offer such units of shares to public to raise money for the business. Section 2 subsection 84 defines share as a share in the share capital of a company and also includes stock. It is a division of share capital of a company, meaning it is only a fractional part of the company's share. For example, the share capital of the company is, let's say, 10 lakhs divided into 10,000 shares of rupees 100 each. If someone takes 100 shares, then they are said to have a share of rupees 10,000 in the company, 100 into 100. There are many such divisions which come together to form share capital. The number of shares which a company can issue will be stated in its memorandum of association. There are different types of share capital as well. The prominent types of share capital are equity and preference. Equity is in fact defined negatively. That which is not preference is known as equity share. Equity share can also be of two types. One with the voting shares, one with the voting rights, and other with differential rights to dividend or voting or any other right. In case of preference shares, they carry a preferential right with respect to payment of dividend, either as fixed amount or an amount calculated at fixed rate. And even in the case of winding up, preference shareholders get a right over equity when it comes to the repayment of capital. Now let's look into the issue of shares. Companies can raise capital by issuing shares to public by inviting them to subscribe to the company's shares. The applicant has to first apply for the shares, and the company will then allot these shares to the applicant. In fact, when the company issues shares, that issue will be successful only if they receive at least about 90% of subscription. If that minimum subscription is not received, then that issue cannot be deemed as valid. The amount which the company would have received will be returned to the applicants. Let's say a company has issued 10,000 shares. It can only allot 10,000 even if it receives excess applications. When it receives excess application, it is known as oversubscription. Companies can either issue shares at par or at a premium price. When issue price is equal to the face value of the share, then it is par. For example, issue price is rupees 100 and the face value is also rupees 100. Then it is issue of shares at par. Whereas, if the issue price is higher than the face value, then the company is said to have issued the shares at a premium. Thus, the excess of issue price over the face value is the amount of premium. For example, if a share of rupees 100 is issued at rupees 20, at rupees 120, then rupees 20 will be the premium. It is a capital receipt and it cannot be utilized for any other purpose apart from which is mentioned in section 52. Now that we know what is a capital, we should understand how is capital decided and which document specifies the same. The capital will be decided by the promoters at the time of incorporation itself, and they specify the same in a document called Memorandum of Association. Now that we know how is a capital decided and where it is specified, we will now see how it is classified into different types. First is nominal. It is that part of the capital which is decided by the promoters to be the maximum capital which can be raised by the company. Once that is decided, the company need not raise the entire capital and it can raise whatever capital which it requires depending on the requirement. Therefore, it only issues a certain amount of capital which is known as issued capital. Once that capital is issued by the company by way of shares, public will subscribe to it based on their expectation from the company and its previous reputation. The amount of capital which the subscribers subscribe to is known as subscribed capital. Once the shares are subscribed by the public, the company will ask them to pay only that part of the share which is required for the time being. That is, the company will ask the shareholders to pay money towards each share in installments as and when required by the company. Installments could be in the form of application, allotment, first call, etc. After calling upon the subscribers to pay the amount, the company will receive the amount from them. The actual amount so received is known as the paid up capital. For example, a company's authorized capital could be 1 crore and divided into 10 lakh shares of rupees 10 each. The company might later issue only 5 lakh shares out of the 10 lakh shares as it might not want to raise the remaining part. This now becomes the issued capital. Let's assume that the public will subscribe to the entire 5 lakh shares of rupees 10 each. Then that will be known as subscribed capital of the company, subscribed by the shareholders. Now out of the 10 rupee share, the company might not require the entire 10 in one go. Therefore, it will issue the same in installments of rupees 2, rupees 5, rupees 3, for example. Therefore, when the applicants apply, they will only pay rupees 2 per share as that will be the application money and the remaining will be collected through allotment and the first call. If the company receives the application money of rupees 2 for the number of shares it has issued, then it becomes the paid up capital of the company. Now that we have looked into the basics of share capital, now let's look into the differences between equity share capital and the preference share capital.
The first basis is type of issue. In case of preference, we can issue both cumulative as well as non-cumulative preference shares. Whereas in case of equity, only one type of equity shares can be issued, that is non-cumulative. When I say cumulative, I mean if for any circumstance dividend is not declared for the preference shareholders, then that dividend gets accumulated and in the subsequent years, the dividend of the previous years have to be paid. That is the cumulative preference shares. Next is the voting rights. When it comes to the voting rights, preference shareholders will have limited voting rights, and whereas equity shareholders will have full voting rights. When I say limited voting rights for preference shareholders, I mean they can only vote on those issues which directly affects their rights. Next comes the right to dividend. Preferential right to receive the dividend exists only for preference shareholders. And in case of equity, no such preferential right is there and company is not liable to pay dividend. Preferential right in this case is the preference shareholders have the first right towards the dividend. Only after they are paid the dividend, equity shareholders will get the remaining dividend. Rate of dividend in case of equity cannot be fixed, whereas in case of preference shares it can be fixed. Next comes the refund of capital. In case of preference shares, only redeemable capital can be issued. That is, at some point of time, there will be an expiry period for the preference capital. That is, the amount which is received from the preference shareholders has to be returned to them. And even at the time of winding up of a company, preference shareholders will have a right over equity shareholders. In case of equity, the amount is refundable only at the time of liquidation, and only if any surplus is left after meeting all the liabilities and after the payment to preference shareholders, the equity shareholders will be paid. Now let us look at how are shares issued. Shares can be issued in two different types, that is either for cash or for consideration other than cash. In case of cash, we actually receive the cash as consideration, whereas in case of consideration other than cash, those shares could be issued for any other consideration apart from cash. For example, if a company buys a machinery from a vendor, instead of giving cash to that vendor, the company can issue shares to them. Even here there are two subtypes, which is in case of issue of shares for cash, the same can be issued at par, wherein the issue price will be equal to the face value, and at premium as well, wherein the issue price will be more than the face value. Likewise, for consideration other than cash also, there are two types. The same two types, that is at par and at premium. Now let us look at an example here. In this case, a company has issued shares at rupees 100 and the face value is also rupees 100. That means the company's issue price is equal to the face value or the nominal value of shares. Therefore, in this case, it will be considered as issue of shares at par. Now let us look at another example. A company issued shares of rupees 10 at rupees 12. That means the face value is rupees 10 whereas the issue price is rupees 12. Issue price is more than the face value, therefore the difference in this case would be treated as premium. So the premium in this case would be rupees 2. Therefore, this is an instance of issue of shares at a premium. In fact, we can see lots of real life examples as well. In fact, recently CDSL, the second largest depository in the country, raised an IPO in which the shares were issued at 149 whereas the face value was rupees only 10. Therefore, in the case of CDSL, the premium was rupees 139. And we have to note that this premium or the securities premium account is not a revenue profit. It should be treated as capital receipt and it will become the liability of a company. Now, where will this securities premium be shown in the balance sheet? And when will it be collected? Premium is usually collected or payable by the shareholders at the allotment stage. And if nothing is mentioned in the problem, premium will be part of the allotment money itself. And also such premium collected on the shares must be credited to an account called securities premium account. And this will be shown under the head equities and liabilities under the category reserves and surplus. When it comes to issue of shares at a premium price, there are no restrictions in the Companies Act, whereas when it comes to its use, there are few restrictions according to section 52. Now let us look at that section. Section 52(2) of Companies Act 2013 says securities premium can be utilized only for the following 5 purposes. The first purpose is it can be utilized to issue fully paid bonus shares. And next is it can be utilized to write off any preliminary expenses. And it can also be utilized to write off any expenses during the issue of shares or debentures. It can be utilized for providing for the premium on redemption of preference shares or debentures. If there is any premium at the time of redemption of preference shares, that premium can be provided from securities premium account existing balance. And lastly, it can also be utilized to buy back company's own shares or other specified securities. These are the 5 uses of securities premium account. Apart from these 5 purposes, it cannot be utilized for any other purpose.
Thank you for watching Excel Academy's first video. I hope you guys understood the topics covered in this video. If you have any doubts regarding any of the topics covered here, please write to me at vishwas@excelacademy.com. Watch out this space for more videos on company law and company accounts. Thank you.